Welcome back. You're watching The Money Show with me, Kavita Thapliyal, and let's talk about investing in volatile market. Markets are clearly volatile, and we're at a level where a lot of investors, especially SIP investors, must be thinking to invest or to not. But you don't have to worry because we've got you covered. And let's talk more on this. I have with me Shweta Rajani, Head Mutual Funds, Anand Rathi Wealth. Shweta, good evening and welcome to the show. So clearly, looking at the fresh levels of the market, a lot of investors must be thinking as to be their regular investment should be continued or not. A lot of investors, especially the matured ones, would be waiting for this kind of a fall of volatility to, enhance their investment amounts also. But then let's talk about the fear part. What, according to you, are normal questions that investors might think of looking at the market condition right now?
Yes, Kavita. So like you said, markets in the last few days have been pretty much volatile. So just to give you certain numbers, we were at, from March till now, if we see Nifty 50 itself had run up by more than 20%. And in the last few days, we've seen a correction, which is of around 6%. Clearly, the questions that is coming in somebody's mind is looking at the geopolitical situation, right? The Israel-Gaza war, what could happen to that? And therefore the impact on Indian markets. That's one question somebody has in his mind. The second question, of course, is with the US debt situation and the interest rate scenario there, what could be the likely impact here? We are seeing the bond yields increasing in US. So, how would global factors impact the Indian market? On the domestic front, there have been questions on valuations to a certain extent. So these are the common questions that I'm seeing clients asking or thinking about. So therefore, what actions they should take on the portfolio.
Shweta, as per your house's view,
Yes.
what other levels within which the market would you be seeing trading? What are the red flags that an investor, in order to continue that investment, should be considering now?
Yeah. Kavita, I'll give you certain numbers here. Now, when it comes to equities, right, short-term volatility is the character of the asset class. So if I just give you some numbers, I did this study for the last 22 years. And every year, from the peak to the trough, there seems to be a correction. Now, this is a normal year, right, when there's no war situation, there's no interest rate worries or COVID-like situation. Even in those years, the average correction one has seen is a 13%, which roughly takes 3-4 months for markets to rebound. Of course, you could have situations like a COVID year or a US financial crisis where the numbers could have been higher in terms of fall. So the point I'm trying to highlight here is that if you see a 10-15% correction in the market, that's a normal correction. You need not worry and therefore do not take any action on the portfolio. If you have equity, then continue with your allocations. Look at those dips, and those should be opportunities for you to invest rather than fearing a correction to the extent of 10-15% in the market. Because over a longer tenor, as long as the fundamentals are in place, which is the current situation, right? After all of this, India is expected to be to be the fastest growing economy. So you'll have your nominal GDP growing at 11-12%, and that would translate into the equity markets over a 3-5 year holding period.
All right. So now also let's consider a scenario, Shweta, okay? Because we know it's a time where people can actually go for unit shopping, which means invest. And even if you're doing an SIP, do not stop your SIP. But I want you to explain a scenario where an investor who invests lump sum, looking at market trajectory, market condition, or maybe, the volatility like this, is a habitual lump sum investor, and an investor who does an SIP. Who benefits out of the situation the most and why?
Yeah. So, let's take a scenario where somebody's been a SIP investor. So did not worry about the market scenarios, and every month went ahead and did those SIP investments, let's say for the last 5 years, right? You've had 18-19, which was not so good year. You've had COVID. The average investor in this case would have still made a 12-13% per annum kind of a return. Now, somebody, let's say, who tried to time it and went correct. So, he was the most luckiest investor who timed it, and every time he timed, he went right. The returns would have been 18% per annum. A reverse situation where somebody was unlucky, and every time he invested, let's say he invested at the peak level of that year, In that situation, his returns would have been a 10% per annum, right? So the point I'm trying to say is you're not missing out whether you try to time it or you don't go right with your timing. 12% is anytime better than sitting on sidelines worrying about not investing. So 10%, 12%, 18% if you go right. Either which ways, the asset class that you be into would give you more than sitting on sidelines and earning a 7% on your debt portfolio.
All right, let's talk about increasing your SIP amounts and the kind of benefit one might get by increasing their SIPs during this time of volatility, and also for all those investors who might be just considering coming out of an investment, owing to a goal which might be like just few years away. These are crucial times because they also want to wind up from their investment in equity and maybe place their money in fixed income. At such timing where there's market volatility, should they just hold on for some time, let the market stabilize, and then come, initiate an exit strategy from an investment instrument which is equity related?
Yes. So, let me break it up into tranches. Let's say you have a goal where you needed the liquidity over the next 3-6 months. Then I would say you can redeem and sit on this, sit on cash, because this is the money you can't avoid. You need it for, whatever obligation or liability you may have had, because it's a tenor which is just possibly 6 months from here. But if you have a goal which is, let's say, 1.5, 2 years away, then don't touch your equity investment. You can continue, or a goal that you had for this year, which can be extended, let's say for the next 1.5, 2 years, then again, extend that horizon of the goal and continue with your equity allocation. This will help you navigate the volatility that one can expect over the next 3-6 months and, get a higher return benefit. And of course, if you have goals which are 3 years plus apart, then even if I would say use this opportunity as you are seeing in the correction and try and top up your SIPs. If you have, let's say some debt which can be shifted into equity while keeping the broader asset allocation in place, you must do that.
All right, let's also, Shweta, look at investment strategy across market caps, looking at the volatility.
Yes.
Any specific changes or shuffling that needs to be done? Any specific winding up of your positions in debt or maybe rebalancing that exposure? What would you suggest?
Yeah. So, talking first about the market cap allocation, looking at two factors, the corporate profitability of large cap, mid cap, small cap, where, I would say if large caps are expected to see a profit growth of around 15% for this year, mid caps around 17%, small cap, the numbers upwards of 20%. Profitability numbers tilting towards small than mid. Valuations, I would say, given the recent correction, large caps are fairly priced. Small cap has gone into an attractive zone. Mid caps, I'd say, slightly on, fair value to expensive zone kind of a range. So in such a scenario of 50% to large, 20 to mid, having a 30 small cap in the portfolio would be a good market cap mix. So, you can look at realigning your portfolios to this market cap. In terms of asset allocation, right? If you have money which is more than 5 years plus horizon, then you can have an equity portfolio which is 65, 70%, or to that matter, 75% equity. And if you have monies which are needed 10 years plus, then having a slightly higher equity, even to the extent of 80% equity would be good to have in the portfolio. So, look at your asset allocations. Like I said, 5 to 6 years, 65 to 75% equity. If more than that, then you can have 80% equity. This is a good time to enter if you have a slightly heavy debt on the portfolio.
So you don't really are on the side of having a higher exposure in mid and small cap. Is it because the valuations in large caps are very attractive and maybe we will see a lot of steam going off mid cap and small cap now? Is that what your analysis is?
So I'm balancing it out at a 50-50, 50% large,
Okay.
50% mid and small at this point of time.
Okay, all right, got it. All right, so this is the kind of strategy one need to adopt looking at the market conditions. But then what about your mutual fund portfolios? Well, if you're someone who's waiting your question to be answered, we have you covered because we'll take a break. And after that, we'll be getting into our query sessions where viewers will join in, ask their portfolio queries to Shweta. And in case you are one of them, you can WhatsApp us your question on 8657974571. You can also email us your question on the Money Show at 18now.tv. So let's take a quick break. Post that more on your financial portfolio, especially question answer session with our viewers after this break. Welcome back. You're watching the Money Show with me, Kavita Thapliyal, and the last leg of the show where we answer your mutual fund portfolio related queries. And just in case you are someone who is looking for a solution or you want to enter in a mutual fund, start your investment journey, you can send us all your questions. We have a WhatsApp number. We also have an email ID where you can send us your queries. The WhatsApp number is 8657974571. And the Money Show at 18now.tv is the email ID where you can reach us. And to answer all your queries, I have Shweta Rajani from Anand Rathi Wealth today. And Shweta, welcome back. Let's take Sandeep's question. That's a question via email. Sandeep says that he's 35 years old and his aim is to earn 1 crore in 15 years. He started investing almost 6 months back, and the portfolio, he wants to know if needs any changes. He's investing 15,000 per month in Parag Parekh Flexi Cap, UTI Nifty 50 Index, Kotak Emerging Equity, Quant Small Cap, Edelweiss Small Cap, Nippon Small Cap also. So yeah, that's the question.
Okay. So, hi Sandeep, and I'll first talk about you achieving your goal. You're doing an SIP of 15,000 now. Generally, when we look at the historical track record of equity, a 14% growth rate is a fair expectation to have. So, what I would suggest is if you're looking at 1 CR at the end of 15 years, you may just need to top up this SIP by 2,000. So if you start off with a 17,000 rupees SIP per month, you'll comfortably get to your goal. If you can't start it today, then start off with 15,000 and maybe, if you can do a 5% top up next year and for the next few years, that should be helpful. Coming to the schemes that you mentioned, some of your schemes are very good. You should continue with them, whether it's the Quant Small Cap, Kotak Emerging. So just the 3 schemes where I would suggest a change is the index fund. See, now what happens is an index has a negative tracking error, right? While an index is replicating a benchmark, but because of the expenses, it ends up delivering certain returns which would be lower than the benchmark. So that is an avoidable fund. The Edelweiss Small Cap, I think you already have Quant and Nippon, so those are good funds. Parag Parekh Flexi Cap again. Rather than that, I would suggest a pure domestic equity fund for your portfolio. So instead of the 3 funds that I mentioned, because you already have a good small cap, I'm suggesting some of the large cap biased funds to you. So you can go in for an SBI large and mid or an SBI Contra that again has a large cap biasness to the portfolio. Second is you can go in for a Kotak multi-cap fund. That will bring in, some market cap diversification to your mix.
All right, so that's the solution for Sandeep. And the investment amount is good enough for him, or you think he should be increasing the investment amount as well later on?
Yeah, so like I said, if he can take it up from 15,000 to 17,000, that would be a good number. And if he can't do it today, then do a 5% step up every year.
All right, let's move on. Let's take Jyotsna's question. And Jyotsna is investing 10,000 via SIP, and the fund that she has in the portfolio are SBI Small Cap, UTI Nifty 50, HDFC Flexi Cap, and wants to know for 15 years time horizon, are these funds good enough?
Yeah. So Jyotsna, here again, 2 of the schemes that you've mentioned are good to have in the portfolio. An SBI Small Cap, HDFC Flexi. These have been consistent performers doing very well. So you can continue with them. Just one fund I would suggest you to change is the UTI Index Fund. Like I was mentioning, an index fund really does not give any flexibility to the fund manager to, take active calls. And in India, I would say, for the next 5-10 years, active funds can easily beat the index. Historically, also, if you see in India, almost 65% of the active funds have outperformed the index, or rather the Nifty 50 index itself. So that's just the one fund I would suggest you to change. And because we are replacing a large cap index fund, I would suggest you can go in for a DSP equity opportunities that again has a large cap biasness in its portfolio. So that would be a good fund for you to invest into.
All right, let's move on. And next question is from Mr. KS Reddy. He wants to know if it's the right time to redeem his investment from Franklin India Smaller Companies and HDFC Mid Cap Fund. He doesn't want to lose out on his gains, it seems.
Yeah. I'll actually break it up into two parts for you. Having a mid cap and a small cap allocation to the portfolio is good at this point of time. If you just heard our previous discussion, I was saying you can have a portfolio which is 50 large and 50 into mid and small. So from a market cap mix standpoint, it's good to continue. But coming specifically to the schemes, I think you can consider shifting from an HDFC mid cap to an HDFC small cap. That's far better placed fund. Likewise, I think there are better small cap funds available in the space compared to the Franklin smaller companies. So my recommendation from a fund perspective would be to redeem these, but you can switch into other small cap funds or multi cap funds. So you can go in for a Quant Active or an HDFC small cap in the portfolio.
All right, so clearly you need to rebalance and reshuffle your exposure out there. But then talking about adding a new small and a mid cap, what would be your general recommendation, Shweta?
Yes, so like I said, at this point of time, small caps are attractively priced because my numbers indicate that, if earnings come in this year as it's projected for small caps, then clearly small caps are sitting at some discount to the fair value. Mid caps, I would say, are in that zone of slightly higher than the fair value zone. So which is where maybe if you have a 10-15% mid cap in the portfolio, you don't need to worry about that. Small cap up to a 30% is good to have in the portfolio. So you can build that space even if it is fresh money that's entering today.
We move on. Let's take Riley's question, Shweta, and she wants you to review her portfolio. And okay, so she has 10,000 SIP that started from 2014 and she stopped it in 2019. So she has Nippon India Small Cap, Canara Bank Small Cap, HDFC Multi Cap, HDFC Mid Cap Opportunity, ICICI Flexi Cap, Parag Flexi Cap, Nippon Multi Cap, and she also invests in NPS Tier 1, that's for retirement gold. She doesn't have any large caps, and she has covered large cap via multi cap. That's what she's written, multi cap and flexi cap, and that's evident from the portfolio also. She wants to understand if she can buy any more blue chips, or she has invested in direct plans, and the intent so far is wealth creation. She wants to know for how long can she stay invested.
Sure. Siley, in equity, one thing that is important is set your goals. So if you know what funds do you need at what time period, that will help you take your decision in a far better fashion. It will help you construct a good strategy for the portfolio. Now, since you're saying wealth creation is your strategy, then you can have an equity heavy portfolio. When you're saying wealth creation, ideally, it means that you have an investment horizon also, which is 10, 15, 20 years plus. So looking at that, I think you should continue with your SIP. You just mentioned you stopped your SIPs in 2019. I don't think you should do that. You should continue with your SIP investments. Coming to the schemes, right? So some schemes that I would suggest you to tweak. Some funds that you have are very good in the portfolio. Some schemes that you can exit at this point of time would be a Parag Parikh Flexi Cap fund. You can exit from the Canara Robeco small cap. You already have, I think, a Nippon small cap in the portfolio, and an HDFC multi cap can be exited. You already have a Nippon multi. It's good that you don't have a large cap fund. In fact, you can look at other categories through which you can get that large cap exposure. Need not necessarily be through a pure large cap fund. So you can consider categories like Contra, which are also large cap heavy and bring in a different style to the portfolio. So, and SBI Contra fund, you can go in for an ICICI dividend yield fund, SBI large and mid cap fund. These would be some of my suggestions to you.
Right, let's move on and let's take Naman's question. And he is doing an SIP of 2000 each in Axis Blue Chip, Axis Small Cap, Kotak Emerging Equity, Parag Parikh Flexi Cap, HDFC Small Cap. And the time horizon is for 20 years. He wants to understand if the fund mix is right and what will be the total corpus after 20 years.
Sure. So, coming back to where your corpus could be, if you continue doing this 10,000 rupees SIP again for 20 years, looking at, like I say, thumb rule, 14% is a good return expectation to have from equities, then you could get to a corpus of 1.3 crores over the next 20 years. So if that helps you meet your goal, then you're good to go. If not, go back to step one and see what's the amount you possibly need after 20 years. And accordingly, see if you need to step up your SIP every month. Schemes that I would suggest you to switch out of or exit at this point of time would be an Axis Blue Chip Fund and Axis Small Cap Fund. Right, these are two funds. Clearly, I would say looking at how the style of the fund is and also the comfort on the asset management company, I would say are clearly schemes that you can exit. Right, Kotak Emerging is a good fund, so you can continue with that, not an issue. A lot of the other schemes also you said are good funds to go ahead to continue your allocation with. But yeah, the two Axis schemes I would suggest you to move out of. As well as Parag Parikh, I'm not so comfortable with the fund because it has a certain international exposure, and I feel domestic equity is clearly much better placed today for the next few years as compared to international. So that would be the third fund I would recommend you to exit out of. Funds that you can invest into, you can go in for multi-cap strategy. So you can go in for a Kotak multi-cap fund. That would be a good addition. A Quant Active would be a good addition. A DSP Equity Opportunities would be a good addition for you.
What if one really wants to have an international exposure? What could be the ways for that now then in this scenario, Shweta?
See, one is that clearly from a valuation perspective, from an earnings potential perspective, Indian equities today seem to be far better placed. So even if you want to take an international exposure, if it is a long-term exposure, maybe this is not the right time for you to enter into it. So you may want to wait and watch the situation and then evaluate again after a year. If the situation on a global front improves, then you can, go through the funds route and participate. Today, you have a lot of options over there. You have ETFs which are available. You have, active funds which are available in this space. But clearly, looking at it, whether on a relative basis, today you may be better off being in India than most of the global funds, not just US, but even if I look at, some of the other funds which could be Euro-oriented, China-oriented, that don't seem to be attractive. So revisit it again after 6 months, 1 year, and then see if you want to, go back building to your international position.
All right, let's move on, Shweta, to our next question, which is from Kanishka. And Kanishka wants a corpus of 3 crores in 2 years, and she wants to understand if she needs to restructure or step up any portion of her mutual fund portfolio. So she has Nippon India Power, Aditya Birla Sun Life Flexi Cap, Kotak Equity Opportunity, ICICI Pru Large and Mid Cap, Nippon Multi Cap, Mira Asset Large Cap, Kotak Flexi Cap, SBI Blue Chip, also investing in NPS.
Yeah. So in her case, yes, I would say a couple of schemes that she need to revisit and rebalance the portfolio. What you may also need to do is have a corpus of around 50,000 per month as your total SIP. That will help you get to your targeted goal that you have. Coming to your schemes, right? You have a sector fund, you have a power sector fund. Now, what happens is in a sector fund, it becomes very critical that you exit at the right time. Because if you don't, then the supernormal returns that you would be making can, within a week, 10 days, get washed off. And what happens is in a diversified fund, if a fund manager has a strong opinion on the sector, he would go and anyways take an overweight position. So that is something which is avoidable. So the power fund can be exited from. Some of the other schemes that you mentioned, Kotak Flexi At one point of time, this used to be a good fund. Today, I would say, given that it has a large AUM, somewhere, we've seen that large size funds tend to have an implication on the portfolio performance. So that would be the other exit that I would suggest to you. Mirai Large Cap again falls in the same category as a Kotak Flexi Cap. One time good performer, but size constraints restricting the fund. Apart from that, an ABSL Flexi Cap can be exited from. Instead of an ABSL Flexi, you can get onto an ABSL Small. Instead of a Kotak Flexi, you can get onto a Kotak Emerging if you want within the same asset management company. These are some of the good options. You can also go in for a Canada Robeco Flexi Cap fund or ICICI Pru Focus Equity fund in the portfolio. So those are, some of my suggestions to you.
All right, with that, thank you so much, Shweta, for being on the show today and helping our viewers with every aspect of their financial portfolio and their investment queries as well. Thank you so much. It's a wrap on the Money Show as well, but then I'm going to leave you with our WhatsApp number and email ID where you can reach us and get your financial portfolio queries answered by our experts. Thank you so much for watching. Goodbye.